You're scrolling through dividend stocks and you find one, 12% yield. Your eyes light up. You immediately think, if I invest $50,000, that's $6,000 per year in passive income. 6 months later, the company announces it's cutting its dividend by 75%. Your income drops from $6,000 to $1,500. Your stock price crashes 40%. You've lost money and income at the same time. This actually happens to investors every single day because they bought the yield without analyzing the stock. Today, I'm going to make sure this never happens to you. By the end of this video, you'll have a complete 6-step framework to analyze any dividend-paying company before putting a single dollar in. You'll know exactly how to check the payout ratio, read the dividend history, assess the company's financial health, and avoid the most dangerous dividend traps. This is the analysis process I use personally after 10+ years of investing. Let's build your dividend analysis toolkit. Quick disclaimer. Everything I share is purely educational based on my 10+ years of personal investing experience. I am not a licensed financial advisor, and this is not financial advice. The companies I use as examples are for educational illustration only and are not recommendations to buy or sell. Individual stocks carry more risk than diversified ETFs or index funds. Always do your own research and consult qualified professionals. Now, let's build this analysis framework. Here's why analysis is not optional. Two investors find the same high-yielding stock. Investor A sees 11% yield and clicks buy immediately. Investor B takes 45 minutes to analyze the company first. 6 months later, the company cuts its dividend. Investor A sees their income drop 80% and the stock price fall 50% simultaneously. Investor B, they found the warning signs during analysis, avoided the stock, and kept their capital safely invested elsewhere. Analysis is not about being overly cautious. It's about protecting your income and your capital. 45 minutes of homework can save you years of recovery from a bad dividend investment. Here are the 6 steps. Step 1, check the dividend yield, but interpret it intelligently. Don't just look for the highest number. The yield sweet spot for quality dividend investing is between 3 and 6%. Below 2%, you're in growth stock territory with minimal income now. 3 to 6% is your target zone, solid income balanced with sustainability. Above 7%, your alarm bell should ring. A very high yield is often the market's way of saying something is wrong. It usually means the stock price has fallen dramatically because the company is struggling, making the yield look artificially high. For example, Coca-Cola at 3.1% with 62 years of consecutive dividend growth, that's a quality yield. Some unknown company at 11% with declining revenue, that's a yield trap. The yield number is your starting point, not your finishing point. Step 2 is the most important check in dividend analysis, the payout ratio. This single number tells you whether the company can actually afford to keep paying you. The formula is simple. Dividends paid divided by earnings per share. If a company earns $4 per share and pays $2 in dividends, the payout ratio is 50%. That means for every dollar earned, 50 cents goes to shareholders. Here's how to interpret the number. 0 to 30% is conservative, very safe, but might indicate the company could be paying more. 30 to 60% is your sweet spot. The company is sharing meaningful profits while keeping enough to reinvest and grow. 60 to 80% is caution territory. It can work if earnings are stable, but there's less buffer. Above 80% is danger. The company is paying out most of what it earns, leaving almost nothing for hard times. If earnings drop slightly, the dividend is at immediate risk. Johnson & Johnson at 44% payout ratio? Beautiful. A company at 95%, that dividend is one bad quarter away from being cut.
One important exception to payout ratio rules are REITs, or real estate investment trusts. REITs are legally required to pay out at least 90% of their taxable income as dividends. That's the law. So naturally, their payout ratios will always look very high, often 70 to 90%. That doesn't mean they're dangerous. It means they're following the law. For REITs, instead of looking at the standard payout ratio, look at the FFO payout ratio. FFO stands for Funds from Operations, which adds back depreciation to net income. It's a more accurate picture of REITs' earnings. When realty income shows a payout ratio of 75%, that's completely normal and healthy for a REIT. Always apply the right standard to the right type of company. Step 3. Analyze the dividend history. This is where you look at what the company has actually done, not just what they're doing today. You want to see at least 5 to 10 years of dividend history. What you want is consistent growth. Every single year, the dividend goes up. Even if it's small increases, the direction is up. That tells you management is committed to returning capital to shareholders through good times and bad. What you want to avoid: flat dividends for years followed by sudden cuts. Once a company cuts its dividend, investor trust is broken. The stock price typically falls hard and fast, and companies that cut once often cut again. The gold standard targets are dividend aristocrats, companies with 25 or more consecutive years of dividend increases, and dividend kings with 50 or more years. These companies have maintained and raised dividends through recessions, financial crises, and global pandemics. That kind of commitment doesn't happen by accident. Where do you actually find this dividend history information? 4 free resources. First, dividend.com. Clean and simple interface showing complete dividend history, payout ratio, and growth rate for any stock. Second, Seeking Alpha, the most comprehensive dividend analysis platform. They give dividend safety scores, growth grades, and analyst commentary specifically about dividends. Third, macrotrends.net, perfect for looking at 20-plus years of financial history in clean chart format. And fourth, the company's own investor relations page. Always go to the primary source. Read the annual report. See what management says about dividend policy. These 4 resources combined give you a complete picture of any dividend stock's history, completely free.
Step 4. Check earnings and revenue growth. Here's a fundamental truth. A dividend is only as strong as the business behind it. You can't pay shareholders money the business isn't generating. Think of the company's revenue and earnings growth as the foundation of a house, and the dividend as the structure built on top. A strong, growing foundation supports a growing dividend. A cracking, shrinking foundation threatens the entire structure. What you need to see in a dividend stock: revenue growing at least 3 to 5% per year consistently. Earnings per share trending upward over multiple years. Positive and growing free cash flow, and critically, earnings growth rate at least equal to the dividend growth rate. If a company is growing its dividend at 7% per year, but earnings are only growing 2%, that's mathematically unsustainable. Eventually, the payout ratio gets squeezed until something breaks. The business must grow to sustain and grow the dividend. Within Step 4, I want to highlight free cash flow specifically because it's the most reliable measure of whether dividends are truly sustainable. Free cash flow is what's left from operating cash flow after the company pays for its capital expenditures, its buildings, equipment, and infrastructure. Here's the calculation. Operating cash flow minus capital expenditures equals free cash flow. That's the real money available to pay dividends. If a company generates $3.50 per share in free cash flow and pays a $2 dividend, the FCF payout ratio is 57%. Healthy, sustainable, room to grow. If a company only generates $1.50 in free cash flow but pays $2 in dividends, they're literally paying out more than they're generating. That dividend is being funded by borrowing or selling assets. It will be cut. The rule: always look for an FCF payout ratio under 75%. Step 5. Check the debt levels. This is where many dividend investors get blindsided. A company with massive debt has to make large interest payments every month. Those interest payments compete directly with your dividend. In tough economic times, management often has a brutal choice: service the debt or pay the dividend. The debt usually wins. 2 key ratios to check. First, debt to EBITDA. This compares total debt to annual earnings. Under 2 times is low and healthy. 2 to 3.5 times is manageable.
Above 3.5 times is where dividends get vulnerable. Second, debt-to-equity ratio. This compares debt to the company's assets. Under 1.0 is conservative. Above 2.0 means the company is heavily leveraged. High leverage amplifies everything: gains when things are good and losses when things go wrong. When you're analyzing a dividend stock, open the balance sheet and look at the total debt line. Then compare it to earnings and equity. A great business with too much debt is a dangerous dividend investment. Step 6. Identify the competitive advantage, or what Warren Buffett calls the economic moat. This is the factor that protects the business from competition and allows it to maintain or grow its earnings and therefore its dividends over many years and decades over time. There are 5 major types of economic moats. Brand strength, like Coca-Cola, where people pay premium prices just for the brand name. Switching costs, like Microsoft, where businesses are locked in because switching software would be incredibly disruptive and expensive. Cost advantage, like Walmart, where scale allows undercutting any competitor on price. Network effects, like Visa, where the more people use it, the more valuable it becomes. And regulation or patents, like utility companies or pharmaceutical companies, which are legally protected from competition. A company with a strong moat can maintain pricing power through recessions, raise dividends year after year, and fend off competition for decades. A company without a moat, one innovative competitor can destroy their business model in years. Always ask, what stops a competitor from copying this business tomorrow?
Let's run through all 6 steps quickly using Coca-Cola as a real educational example. Step 1. Yield at around 3.1%. Sweet spot. Step 2. Payout ratio around 72%. That's on the higher side, but for a mature consumer staples company with incredibly stable and predictable cash flows, it's historically been sustainable. Worth monitoring, but not alarming. Step 3. Dividend history. 62 consecutive years of dividend increases. Dividend king status. Exceptional. Step 4. Revenue and earnings. Steady 3 to 5% growth annually, consistent with what we want to see. Step 5. Debt, around 2.5 times EBITDA. Manageable, though consumer brands do tend to carry more debt. Step 6. Competitive moat. Brand strength that is almost unparalleled globally. Extraordinarily strong moat. Overall verdict on Coca-Cola? It scores well across most of the framework, making it worth considering for a dividend portfolio, with awareness of the higher payout ratio and slower growth profile. This is how you apply all 6 steps to any dividend stock in under an hour. Here's your complete dividend analysis checklist to save and use before buying any dividend stock. Step 1. Is the yield in the 3 to 6% sweet spot? Step 2. Is the payout ratio under 60% for regular companies or under 80% for REITs? Step 3. Is there 5 or more years of consecutive dividend growth, ideally 10 or more? Step 4. Are revenue and earnings growing and is free cash flow positive with an FCF payout ratio under 75%? Step 5. Is debt to EBITDA under 3.5 times? Step 6. Can you clearly identify the company's competitive moat? If you check all 6 boxes confidently, you have a high-conviction dividend candidate worth serious consideration. 4 to 5 checks means research further before deciding. Under 4, probably avoid no matter how attractive the yield looks. This process takes 30 to 60 minutes. Your portfolio will thank you for every minute you invest in it. Let's bring it all together. The 6-step dividend analysis framework. Step 1. Check the yield, 3 to 6% sweet spot. Step 2. Check the payout ratio, under 60% for regular companies, under 80% for REITs. Step 3. Review the dividend history. You want 5 to 10 plus years of consistent growth. Step 4. Analyze earnings and free cash flow. The business must be growing and generating real cash. Step 5. Examine debt levels.
debt to EBITDA under 3.5 times. Step 6, identify the competitive moat, a clear, durable advantage that protects the business. Run every dividend stock through this pipeline before buying. The ones that pass all 6 steps go into your portfolio. The ones that fail, you say, "Thank you, next," and you move on. This is how you build a dividend portfolio that doesn't just look good on paper today, but keeps paying you, growing your income, and building your wealth for decades. Analyze first, invest second, profit consistently. If this framework gave you a clear system for analyzing any dividend stock before buying it, please hit that subscribe button and turn on notifications. Every week on the Investing Whiteboard, I break down investing concepts this simply using real experience from over a decade in the markets. In my next video, I'm showing you exactly how to buy your first ETF step by step, including how to open a brokerage account, find the right ETF, place your first order, and set up automatic investing. It's the most practical, actionable video yet. Drop a comment below and tell me, which of the 6 steps do you think is the most important one? I personally believe it's the payout ratio, but I'm curious what the community thinks. I read every comment. Thanks for watching. Remember, great dividend investing isn't about finding the highest yield. It's about finding the most sustainable yield from the strongest business. See you in the next one.